Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dauch Corporation Annual Report. Dauch Corporation offers a wide range of businesses and services that cater to the automotive industry. The company's driveline segment provides various drivetrain components such as front and rear axles, drive shafts, differential assemblies, clutch modules, balance shaft systems, and disconnecting driveline technology for electric, hybrid, and internal combustion vehicles. In addition to its driveline segment, Dauch Corporation also operates a metal forming segment that offers a diverse range of products. These include engine, transmission, driveline, and safety-critical components for traditional internal combustion engines, as well as electric vehicle architectures. The company's products are used in various industries such as light vehicles, commercial vehicles, off-highway vehicles, and industrial markets. Dauch Corporation operates globally with presence in North America, Asia, Europe, and South America. Its extensive product offerings and global reach make it a significant player in the automotive industry. The significant increase in Dauch Corp's stock price over the past year can be attributed to several key news events and developments. The most notable event was the acquisition of Dauch in February 2026, which is expected to nearly double Dauch Corp's size and drive higher sales and earnings due to planned synergies and restructuring. This transformational acquisition has led analysts to project significant increases in free cash flow starting in 2027, as operating leverage from the merger takes hold. Additionally, strategic board appointments and executive stock awards have strengthened governance and management alignment, positively impacting investor confidence. Furthermore, Dauch Corp's improved adjusted earnings per share and expanded adjusted EBITDA margins indicate underlying operational strength, even while managing integration costs from the acquisition. Analyst sentiment has also turned more bullish, with EPS estimates rising significantly and several firms initiating or raising coverage with buy ratings and price targets. The combination of these factors has contributed to Dauch Corp's 77.5% stock price increase over the past year, exceeding a 25.43% return. As the company continues to integrate Dauch and realize synergies, investors remain optimistic about its future prospects. The primary drivers of revenue growth and decline can be identified through a review of key factors affecting sales and market demand. On the growth side, the acquisition of Dauch Group plc for $1.7 billion has been a significant contributor to increased revenue. Additionally, long-term supply agreements with contractual guarantees have also driven revenue growth. Furthermore, reimbursements received for pre-production costs related to awarded programs have added to the company's revenue. On the decline side, reduced purchases by key customers such as General Motors Company and Ford Motor Company have led to a decrease in revenue. The market acceptance of new or existing products has also contributed to this decline. Moreover, a decrease in demand for light trucks and SUVs produced by these companies has further impacted revenue. In terms of geographical regions, North America has seen an increase in revenue from $4,339.6 million in 2025 to $4,444.8 million in 2024. Similarly, Asia has experienced growth with revenue increasing from $536.3 million in 2025 to $611.8 million in 2024. Segment-wise analysis reveals that the driveline segment has seen a decline in net external sales from $4,251.9 million in 2024 to $4,176.5 million in 2023. In contrast, the metal forming segment has experienced growth, with net external sales increasing from $1,873 million in 2024 to $1,903 million in 2023. Overall, these factors have contributed to the company's revenue growth and decline, highlighting the importance of strategic acquisitions, supply agreements, and market demand in driving business performance. The net income of a company underwent significant changes between 2023 and 2025. Initially, it decreased by $54.7 billion from 2023 to 2024, followed by another decline of $14.2 million from 2024 to 2025. This represents a substantial decrease of 56% in net income over the two-year period. The profit margins also experienced changes during this time. The gross margin remained unchanged at 12.1%, but the operating margin decreased significantly, dropping from 3.9% to 1.9%. This decline in profit margins can be attributed to a substantial decrease in net income despite an increase in revenue. Several factors contributed to these changes. Delays in new product launches and increased costs associated with warranties and recalls negatively impacted the company's financial performance. Additionally, the shift towards electric vehicles, cyclical nature of the automotive industry, and competition from Chinese OEMs also played a role. Furthermore, uncertainty related to geopolitical conflicts, macroeconomic factors such as inflation, renegotiated trade agreements, tariffs, and import restrictions further exacerbated the decline in net income and profit margins. The company's financial performance indicates a consistent generation of positive operating cash flow. The data from various pages confirms this trend. On page 38, it is stated that the net cash provided by operating activities was $411.6 million in 2025. Furthermore, on page 39, the operating cash flow is reported as positive at $1,395.5 million. This positive trend is not limited to a single year. As mentioned on page 58, the company has been generating positive operating cash flow in both 2024 and 2023, with net cash provided by operating activities indicating a consistent increase. Additionally, on page 77, the operating cash flow for 2025 and 2024 is reported as $19,900 million and $11,900 million respectively, further solidifying the company's ability to generate positive operating cash flow. The overall picture presented by these figures suggests that the company has a strong financial foundation, with its operating activities generating significant amounts of cash. This is a positive indicator for investors and stakeholders, as it implies that the company has the resources needed to invest in growth initiatives, pay off debt, or return value to shareholders through dividends or share buybacks. The company's debt level has undergone significant changes over the past few years. Initially, indebtedness increased substantially due to a business combination. This was followed by an increase in interest expense from 2024 to 2025, rising by $15.1 million or 8.1%. However, interest paid decreased by $8.9 million during the same period. The total debt outstanding also saw a substantial increase, jumping from $2,624.8 million at year-end 2024 to $4,049.5 million at year-end 2025. Interestingly, there is a predicted decreasing trend in interest expenses from 2026-2030, with a projected value of $239 million by the end of this period. However, starting from 2031 and beyond, interest expenses are expected to increase again, reaching $497 million. In contrast, when comparing interest expense changes over longer periods, there is a slight decrease of -$0.6 million from 2023 to 2025. Overall, while there have been fluctuations in interest expenses, the company's debt level has increased significantly, with total debt outstanding more than doubling between 2024 and 2025. The company has shown promising results in certain segments and regions. The metal forming segment stood out as a top performer, indicating strong growth and efficiency. This success had a ripple effect on the driveline segment, which benefited from the continuity of supply provided by metal forming. In terms of geographical performance, several global facilities have excelled, receiving awards for their achievements. These include Changshu, China, Minerva, Ohio, and Chakan, India. The recognition received by these facilities is a testament to their operational excellence and commitment to quality. However, the award received by the former Pune facility raises questions about its performance, making it unclear whether this was a positive or negative indicator. Management is optimistic about the company's outlook, citing several key strategies that will drive growth and value creation. The company aims to build value for stakeholders through operational excellence and cost management, while growing its hybrid and electric vehicle business as end-user acceptance increases. To achieve this, management plans to launch new programs with major customers, maintain high-quality standards, and position the company for future growth with next-generation programs and technologies. Additionally, the company is diversifying its core business through acquisitions, such as the recent business combination with Dauch, which will create a leading global driveline and metal forming supplier. The company also expects to realize significant strategic benefits and synergies from the transaction, including revenue growth and operating efficiencies. However, management acknowledges that there are risks associated with achieving these objectives within a reasonable time frame. In terms of capacity requirements, the company will continue to evaluate its needs in light of current and projected market conditions, redeploying assets to increase utilization and reduce future capital spending. Overall, management's outlook is positive, with a significant excess of fair value over carrying value for the driveline segment and no expected goodwill impairment in the near future. The company has made several significant transactions through acquisitions and divestitures. In terms of acquisitions, the most notable one is the acquisition of Dauch, although specific details about this transaction are not provided. Another business combination is mentioned, but no date or further information is given. On the other hand, the company has also engaged in various divestitures. One significant example is the redemption of $127.6 million worth of 6.25% notes due 2026 and 2024. Additionally, the company sold all its remaining equity securities of REE Automotive in 2024, resulting in a loss of $0.1 million. Furthermore, certain operations have been divested, although no specific details are provided about these transactions. These acquisitions and divestitures demonstrate the company's strategic efforts to manage its assets and investments effectively. By acquiring new businesses or assets, the company can expand its capabilities and increase its market presence. On the other hand, by divesting certain operations or securities, the company can reduce its liabilities and improve its financial performance. The company's financial activities in 2025 reveal that it has not paid dividends to its shareholders. However, the company did engage in share buybacks, which is an alternative way for companies to return value to their investors. Specifically, the company made principal payments on certain notes and repurchased some of these notes, indicating a share buyback activity. This suggests that the company chose to use its resources to purchase back shares rather than distribute them as dividends. Concerns about inventory buildup and supply chain disruption are evident in various aspects of the company's operations. On the inventory front, there is a growing concern about excessive stockpiling, with gross inventories exceeding usage requirements on page 65. Furthermore, inventory levels have increased by 6.7% year-over-year, with raw materials and work in progress increasing from $362 million to $383.5 million, page 66. This trend is also reflected in the increase of $2.6 million in inventory from 2023, page 110. Supply chain disruption is another pressing concern, as the company relies on suppliers in local markets that have not yet proven their ability to meet requirements, page 6. The uncertainty surrounding tariffs and trade relations may impact supply chain stability, pages 29 and 48, while supply shortages, labor shortages, and exchange rate volatility can affect supply chain resilience, page 48. These concerns are further exacerbated by the potential difficulties with supply chains of customers and their suppliers, as well as uncertainty related to end-user acceptance rates and possibility of production shortfalls or delays, pages 13 and 16. The inventory valuation allowance increased on page 140 indicates potential write-offs of excess and obsolete inventories. This suggests that the company is struggling to manage its inventory effectively, which can have significant financial implications. Overall, the concerns about inventory buildup and supply chain disruption are real and require immediate attention from management to mitigate their impact on the business. That concludes the financial summary for Dauch Corporation. Feel free to comment below, and I will be happy to answer them when possible.